Welcome back to Trading IQ, where we will learn the unlimited nature of the stock market. This is Shourabh Bhattacharjee, and in today's video, as part of the Mark Douglas's Trading Psychology playlist, I'm going to share a very important fundamental aspect, which is the market is always right. In my last video, I have shared the unlimitedness nature of the stock market and how can you conceptualize the unlimitedness of the stock market. So if you haven't watched this video, I would paste the link on the I button and on the description as well. You can go check it out. Now, in today's video, what I'm going to share is very important because sometimes we are interacting in the stock market and we know how it works. Like everyone has their own belief or own perception on how the stock market works, but sometimes we try to complicate things and we don't look at things in a very simplified version, which would make our life very simpler. And when we are dealing with the stock market, we can do it with ease, and that's the goal. When you're dealing with the stock market, you should do it effortlessly, without thinking much, without, like, when you wake up in the morning and when you go brush your teeth, do you have to think anything? You do it effortlessly because that's like your second nature, and that's how you should be able to interact with the market. And how can you do that? If you have a simplified version of it, of how the market works. So how does the market work? So to form a market, there has to be two traders willing to buy and sell a product. The buyer is willing to buy a product, and at the same time the seller is willing to sell that product, and that is when they enter into a trade, and that's how the market is formed. It is not only stock market, it is in general the overall market. So in the stock market it works little differently, because when a person is willing to buy a stock at a certain price, he is estimating its future value and then putting on a trade, because he thinks that the price would go up in value in some times. Like the timeline could be anything based on everyone's plan, right? Now the seller has a different perspective altogether. He thinks that the current price is higher than what it should be in future, and that's why he's selling it, right? So these are two different forces. One thinks differently than the others, right? So that's how a market is formed. Now, when you're putting on a trade, you may think that it is the most best decisions that you have ever made in your life, but market does not care about that, because the price of a stock is being decided by the force, this buying and selling force. Now, when you have true intention of buying a stock and you believe that it will go up because of your some analysis, you might be altogether wrong, because you have no control on what other people are thinking, right? So you are not forming the market unless you have enough capital, enough volume to move the price up from A to B. So how does price moves in the stock market? So for a price, let's suppose for a given stock to go up from 10 to 11, all the buy order at 10 has to be completely sold out for the price to go up from 10 to 11. Now, if you have that capital, if you have that much of capital, if you think that you can move the price up with your own capital, that's when you can have those beliefs, and that's when you can think that you can move the price up and then you can get the benefit out of it. And that's how different institution investors, hedgers, money managers, and these large institutions controls the market, right? Because they have the capital to do so. Now, as a retail investor, you have no control whatsoever, right? So what can you do? You have to go with the flow. You have to identify those patterns wherein you believe that there are some big players are coming into the market, and you have to ride along with them. That's the best you can do. You have no idea, you have no control on how the price would go up. You can just take a calculative prediction, and that's why having a trading plan is a must. Because see, the technical analysis would give you opportunities here and there, but it is not guaranteed that this trade will work out, this particular trade will work out. You have to have a series of trades. And that's when you will eliminate the fact that you are right, market is wrong, vice versa. You have to understand this fact that the market is always right. Whatever price reflection that you see from the market, that is the reality. And you have to accept the reality, and you have to accept that the market is always right. So you will not have that conflict that you thought that the market will bounce back from its all-time low. It does not have to. If, let's suppose, a stock is approaching its all-time low and you think for yourself that it will bounce back from its all-time low, and you would put in all the capital on that trade, you would end up in a losing trade if you act on this belief, because market can do anything, right? And if the market is approaching its all-time low, that means there are more number of sellers who thinks that the current market price is way above than what it should be in future. And that's why the selling pressure, and that's why it is approaching its all-time low. Now, why do you believe that the market would go up, bounce back from its all-time low, right? So of course it can, but you have to have a diversification of such plans. Like if you approach that whenever it goes to its all-time low, then only you will buy. So you have to have that diversification of that same plan over 10 trades, and that's when one or two might work out, and you have to kind of carry them forward and grow them to unlimited profits. And those which are not working out, just cut them loose whenever you see that it is not working out. And so whenever you see it is not working out, you have to understand the market is always right. You have to acknowledge your mistake. You have to acknowledge that you might be wrong in this trade, so you should get out. Because when you think that no, you are right, market is wrong, market is telling wrong things, market should always bounce back, it will bounce back. You have that optimism, that your optimistic thought pattern will kick in, and you would think that market will bounce back from here on. Maybe not from this price, maybe somewhere down the line or somewhere down the line. And by the time you see that, you have lost half of your capital, right? That's how you lose money. So if you have a plan, if your plan is to buy all the stocks from its all-time low, just wait for it and diversify that approach. Spread it across 10 trades, and then from there on, grow a couple of them which might work out in your favor, and then just carry them forward and just grow potentially unlimited returns. You can only do that if you have that concept that the market is always right, and you can be wrong. So you have to understand this point, that you are most of the time you're wrong. That's when you can make money. Whenever you're right, you're pouncing on it and you're not letting it go. You're taking it forward, you're carrying it forward, and you're growing it to its unlimited nature. That's how you can potentially earn wealth. Let's suppose a market, a stock always bounces back from its support level, right? So whenever it approaches its support, you decided to, you have seen as an observer that it always bounced back from its support, And now you decided to buy when it is approaching its support level. And you put in all your amounts, like go all in type of an approach is what I'm saying here. If you have diversified it, that's fine. And you have to potentially get out of it if you see that it is not working out. So let's suppose it is approaching support the third time, you put in all your amount there. And it might happen that whoever was trading at the support level, like the large institution, because those are the institutions or big players are controlling most of the market. And you might not know how silly it can be, how silly of a thought it is, but it is the fact that those traders who were putting on the trades when it was approaching its support, they're out for lunch. They're not available to trade on that stock. And you put all your amounts on that support level, and it just went below. And you would think that it bounced back a couple of times, it might bounce back from here on. So when it's going down and you see a green candle, you think that, oh, now you're relieved that now it will bounce back from here on. Again, if you see some red candles, and again you go into depression. And then when again you see some green candles, couple of green candles, you would think that, oh, now I'm relieved, now it is bouncing back from here on. But after some times you will see that you have lost half of your capital. So you have to identify when it is not working out and when you have to cut off your losses. And that's how you can be successful in the stock market. And you know, I'm telling you all these things from my mistakes. I have done all these mistakes numerous times. Now I understood this fact, because you know, that's why I regard him the most, Mark Douglas, because his style of teaching, his you know, candid way of sharing feedbacks are awesome, amazing, and you know, it changed my life. So again, I hope you like this video and you're liking my approach. Again, I would request you to please subscribe to my channel, like this video, share with your friends, and I will see you on my next video. Thank you and have a great day.